Welcome to the Build Wealth Canada podcast, where it's all about becoming debt-free, accelerating your wealth, and taking control of your money. Now, here's your host, Cornell Schreiber.
Hey, it's Cornell, and welcome to the Build Wealth Canada podcast. With the new year kicking off, investing is top of mind for many of us, especially with all the new contribution room that many of us just received in our different registered accounts here in Canada, whether it's our TFSA, RRSP, our RESP, and or our FHSA. And of course, don't forget to actually top those up if you have them. Now, before we start topping those up and investing the money that we're putting in, it's natural to start comparing what's out there and contemplating whether we should change the investments that we're going to be buying this year. And sure, we can just continue to buy what we've always bought, and that can be the best option in many cases. But what if the fees changed on the investments that we typically buy? Maybe now we can get something comparable for lower ongoing fees. In other words, a lower MER. Maybe you've decided to change your asset allocation this year, also known as your mix between stocks and bonds in your portfolio. Maybe you want more stocks and less bonds going forward, or vice versa, depending on that trade-off you get between higher expected returns and higher volatility with stocks versus getting lower expected returns but decreased volatility the more fixed income or bonds that you have. And of course, the optimal investments that we use for our short-term and mid-term cash needs change constantly too. Different products get issued, interest rates change, different promotions happen where you can get a really high interest rate in our savings account temporarily, for example. So it's worth keeping an eye out to see what is currently being offered in the Canadian marketplace. And it's something that I like to do myself for my own portfolio and then share with you what I found so that you can benefit hopefully as well. Now, of course, when doing this, especially with the stock and fixed income portion of your portfolio, it can be easy to make some mistakes. And once your portfolio gets into that 6 and 7 figure range, even tiny mistakes can equate to tens of thousands of dollars and even as high as hundreds of thousands of dollars if, for example, you are significantly invested in some high fee products. For example, if you're paying anything over, let's say, 1% MER, I would mark that as a sort of state of emergency in your portfolio, as in those cases, you could potentially be paying literally hundreds of thousands of dollars more in fees over your investment lifetime compared to an investor like myself who just buys low-cost total market index ETFs. And heck, you can do the math yourself. You can ask AI. You'll get to the same conclusion. Heck, even with something like an asset allocation ETF like ZEQT, for example, you could be paying 0.2% in MER, which is 1/5 of the fee compared to some 1% fee mutual fund that someone sold you. And just as an aside, if you ever want to see which ETFs I buy and why, and what accounts I put them in for maximum tax efficiency, I get this question a lot, so I thought I'd mention it here. You can get that over at a live Google Doc that I actually created and that I continue to update as things change here in Canada. And I actually just updated it for 2026. And so if you do want to get that, it's over at buildwealthcanada.ca/guide. That's buildwealthcanada.ca/guide. You can just go there, put it in your email, I'll email you the link, and then you can see it. And as things update, that gets updated automatically as well. So that's one way that you can keep up to date on that. Okay, so what are these mistakes that we could be making? And what types of errors in judgment are common when we Canadians choose which investments to buy? And are there any blind spots that we should be aware of? And how can we properly do the due diligence to ensure that we are buying the best investments for our needs? And how can we properly compare investments and not make a mistake in our analysis? So we're going to cover all that and more in this episode. Now, our guest today is Danielle Nezel. She is a very experienced and passionate educator when it comes to DIY investing here in Canada, especially when it comes to index investing using low-cost ETFs, which, by the way, as many of you know, is literally how I invest all my money. She is one of the hosts of the ETF Market Insights YouTube channel, a really great channel, is a frequent speaker at many different industry events here in Canada, and she works at the largest Canadian ETF provider here in Canada, BMO ETFs. So I find she has incredible access to information working there, like what are the top mistakes that DIY investors make here in Canada. And she also has the analytical training on things like how can we properly analyze ETFs and how can we compare them properly and do our due diligence correctly when we're choosing investments for ourselves. So we cover all that and more in the interview. And now let's get into the show. All right, Danielle, welcome back to the show.
So great to be back on the channel.
Awesome. Danielle, to kick things off, what are some of the major and common mistakes that you see Canadian investors make when they do their own analysis on which investment to buy?
I think the number one is just focusing on one metric. So some investors just look at one performance number or perhaps a yield number, and that's really not giving them the entire picture of an ETF. We're seeing, for example, covered call ETFs are very popular in Canada, and investors are purchasing these just based on the distribution yield. And if you're looking at a distribution yield that's 10, 11, 12%, there's a lot more going on in that ETF that you're not aware of. Like, how is that an investment firm getting that yield? Similarly, with performance, if you're looking at just a 1-year performance number, you're really not getting the entire picture of that ETF. How is it performing over a longer track record in different market cycles? So focusing on just a couple metrics is not going to give you the full picture on that investment. A lot of investors also don't consider how that investment fits with their risk objectives and their goals for their overall investments. So when you're adding an ETF or an investment fund to your investment portfolio, how is that fund going to get you to your goal? And connecting those dots is really important. If your goal is to grow wealth, maybe having something like a covered call doesn't make sense because you're trading away growth for income. So really thinking about linking that investment product to your objectives, goals, and risk profile. And lastly, I would say, this is a big one and I talk about it a lot. Investors don't think about managing risk. They're only thinking about managing return. How can I grow my money to the highest amount that's possible? But you have to think about the risk you're taking on to achieve that return. And does that risk, again, does it match your investor profile? So those are some of the things I see investors maybe missing when they're thinking about building a portfolio for themselves.
Mm-hmm. Yeah, especially we've had such good markets for so long now. I can see it being a little deceiving where people look at that total return number, especially like over the last 2 years, and then just looking at that and saying, this is amazing, and just assuming that's going to be the story going forward indefinitely with no major corrections. So it sounds like, practically speaking, when somebody is looking at investments, of course, yes, look at the return number, make sure that it's over a long enough time period. And then I think another practical one would be to see, okay, well, how did it perform in 2008, for example? Because then you get that understanding of, okay, here's the potential volatility that I'm taking on for this potential return that I might receive. Would you agree with that? Do you have anything to add to that?
Absolutely. A longer track record is better. And we'll get into that later. We talk about due diligence, but look at that fund's performance over the long term. Understand how it performed in different market environments and different interest rate cycles, right? During 2008, but also during the pandemic. Some stocks did so well during the pandemic, but now have cooled off. So there are different market environments that benefit certain investments versus others. And the longer track record you have to look at, the better off you are as an investor. You have way more information. We say history doesn't repeat itself, but it rhymes. That's very true with investing.
And if somebody is new to this, and let's say they're looking at one of your ETFs, for example, I'm thinking like ZEQT, for example, right? Where it's using indexes that have been around for a very long time. They're highly reputable, highly trusted. They're from S&P, a lot of them, right? So it's pretty much as reliable as it can get on that side. But maybe the ETF itself is relatively young compared to some of your older ETFs, right? So if someone is new to this and they're saying, well, I want to see, let's say, the 10-year history or how it did in 2008, let's say, but this ETF doesn't go back that far because it didn't exist, even though the underlying holdings do go back that far. What would you recommend in terms of how someone can do this research themselves so that they can actually see that history, so that they know what to expect when they are, let's say, buying a ZEQT? Or I just use that one because that's one of the more newer ones that you have compared to some of your other ones, but it's actually the underlying holdings have been around for a really long time.
Right. So that's something to consider when you're thinking about a fund of fund. So if you're buying an ETF that holds a basket of ETFs or a mutual fund that holds funds, you can look at the underlying fund's performance to see how they perform. So as you mentioned, ZEQT, I think it's about 4.5 years old. We haven't hit that 5-year track record yet, but all the underlying holdings in ZEQT have, I think, almost all of them a 10-year track record. Just the small and the mid cap might be over 5. But you can look at those individual ETFs and understand that. So you can look under the hood, really, and understand those ETFs' performance over the long term. And in fact, you can even look at the index. It predates the ETF. So the S&P 500 index has been around way before BMO's S&P 500 ETF. You can actually look at the index performance of those way beyond how long it's been tracking it as in a fund form.
For sure. Yeah, and I noticed too on the ETF fund pages, when you look up that ETF, if it is a passive index ETF, it always says what index it's basically trying to mimic. And then if you even just Google that, right, you could pretty much pull the information on that pretty easily.
Correct.
Yeah. That's great.
Online, very easy for investors to pull.
Awesome. Yeah, I just want to mention that because I know you and I have been at this for a long time. But when I think of some, like when I talk to younger people or people that are just maybe transitioning from having everything managed by an advisor and now they're transitioning more so to be a DIY investor, these are some of the things that people have to learn for the first time, even at older ages, if they did that transition to DIY and now they actually want to see, okay, how have things performed historically when you're not just outsourcing it to someone else to pick the investments for you. So that's great. Now, when we are looking to compare two investments, whether it's a mutual fund or an ETF, what is the process that we should follow to make sure that we are doing appropriate and thorough due diligence?
Right. So I mentioned earlier, understand what is your goal for that investment account, that portfolio, and what's your risk profile? Those are two things you need to answer for yourself before you can know if that ETF is right and fits into that. Then we want to look at the ETF. What is the reputation of the firm? Who is managing that ETF for you? BMO, we've been an asset manager for a very long time. We've been an institution in Canada for over 200 years. We have operational stability. Those are the types of things you want from an ETF provider. Track record, again, you want to look at someone who's been doing this for a long time. You don't want something that was just listed this year. You don't have a lot of information on how that ETF is formed. So reputation of that firm. And we have seen in Canada, smaller firms come up, I won't say who, but come up against some issues and have shut down. And that leaves investors' assets frozen. And that causes a lot of issues for investors. So know that firm, trust that firm, research that firm. Then you want to know the strategy of the ETF. Does it match your objectives? Is it active? Is it passive? Is it tracking an index? And that will give you a really good understanding of the types of equities or fixed income that it's holding. Look at the track record. Past performance will give you a great picture of how that ETF has performed over different market cycles. Risk metrics. I know we touched on this earlier, but how much risk are you taking on with this investment? Yes, you can look at performance and you can think about how it may perform in the future, but what's the risk that you're taking on to get that return? Are you invested in a sector or a concentrated sector where that could have a lot of higher risk versus something that's a broad sector ETF? So know exactly the risk metrics. Risk metrics we look at are standard deviation is one of them. How much is the performance moving away from the median performance or the average performance? And beta. Market beta is always characterized as 1. So the S&P 500 would have a beta of 1. And then a beta of a different fund is higher than 1. It's characterized as riskier than the market. A beta lower than 1 is characterized as less risk than the broad market. So a couple of risk metrics to look at. Fees are top of mind for all direct investors. Do the fees make sense for the strategy? If it's tracking an index tracking strategy, you should expect fees to be a lot lower than something that is an actively managed strategy or has an options overlay. We have a really great comparison tool at BMO. It's free to use for all investors. BMO.com/ETFs. Look at our tools. Our fund ETF compare tool. You can put up any 5 ETFs or mutual funds that are listed in Canada. You can compare all these metrics. Great tool for investors to use in their due diligence process.
That's great. And I think the big call out there too is that it's not like they have to be BMO ETFs or BMO products, right? It's throughout the Canadian market, right? So it's not like you're...
Correct.
Yeah, you can actually compare from other providers and things like that.
Mm-hmm.
Yeah. I think that's a valuable thing. I noticed when looking up an ETF, if you just Google an ETF and you go to the facts page for that ETF, whether it's from BMO or Vanguard or iShares, they always have that risk part as part of that facts sheet. Do you know if that's something that's regulated, or can an ETF provider just say, oh yeah, we feel it is this level of risk? Is it subjective like that, or is there some very clear where the regulators have come in and said, okay, no, this is the criteria, this is the definition of high risk, this is the definition of low risk?
Yes, there is a specific criteria, and all asset managers must review the risk of their funds every year when we refile our prospectus. The risk is we use standard deviation for the risk, and it will change every year. For example, when we look at a 10-year standard deviation, so when 2008 returns rolled off that 10-year after 2018, we had to readjust a lot of risk profiles because all of a sudden we had one really down year come out of the data, and this helped lift risk profiles slightly on certain funds. So that's just an example how it works. But the industry looks at 10-year standard deviation, and that's reevaluated every single year at the end of the year.
Very interesting. So it's actually a quantitatively determined thing. Yeah, I was curious about that, whether it's that or whether it's just like marketing, right? Where, oh, look how low risk our thing is. And then you have high returns. And so people flock to that because, oh, you get high returns but it's still a low risk fund. But you're saying the regulators control that pretty tightly to prevent companies from being able to create that kind of a story when it's actually can be deceptive, right?
Correct.
Yeah.
You can't market a risk, whatever risk you'd like to get a fund.
Yeah. Well, I know for yourself being in the actual industry, it's probably obvious to you guys, but I know from a regular investor person, like a regular DIY investor like myself, we have to figure out like, well, which part of everything we see, we have to ask ourselves, is this marketing or is this an actual regulated quantitative thing, right? And then so much of being a good investor, I find, is being able to choose one from the other, what you can count on, right? Because you've mentioned this before, right? There are so many companies that kind of try to push the envelope in terms of their marketing. And so we have to do the due diligence as DIY investors. So, but yeah, thanks for sharing that. That's really good. That's really good to know. The fees that we pay on our investments can literally make a difference of hundreds of thousands of dollars over our lifetime. To help us all determine if we're paying near the low end versus the top end of the spectrum when it comes to fees, what would be considered a high fee versus a low fee for the Canadian investor?
Right. So I think the first thing an investor needs to understand is, does the fee for that product reflect the work being provided to you by that asset manager? Typically, we see index products or ETFs that track an index at being very low fees, something in the range of about 10 to 20 basis points. And that's because operationally for an asset manager, it's a fairly easy portfolio to manage. You're basically told what companies to purchase and what weights they should be. Versus if you're looking at an active strategy, active managers have a lot more overhead. They need more tools to make active decisions. And their hope or their promise to investors that they don't always deliver on, but the hope is to beat that passive index performance. So active managers generally have higher fees, and this can range. There's a very broad range for what we're seeing active managers charge. The ETF world has really brought those fees down. A lot of active managers charge about maybe in the range of 70 to 90 basis points. But historically, we have seen asset managers go 100 to 200 basis points, about 1 to 2%. So that can really range. And another big one is options overlay strategy. So if you're thinking about a covered call strategy, options overlay strategy takes a little more work for a portfolio manager to be writing those options and rolling them over every 30 days. Or whatever the terms may be. So a lot of option overlay strategies you're looking at in the realm of about 60 to 90 basis points. Again, at BMO, our MER for our option strategies are around 70 to 75 basis points.
And can you refresh my memory about, for your asset allocation ETFs, what the MER is now? Because you guys had a rate cut relatively recently.
Thanks for bringing that up. So we actually just cut fees, which is exciting because we're in an inflationary environment and things are becoming more expensive. And here we are, we're cutting our fees. So we cut our management fee on our asset allocation ETFs from 18 basis points to 15 basis points. that's really exciting. It won't be reflected in the MER of that fund until it has been cut for a full calendar year. So the cut is there, the savings are there, but when you're researching the information, look at the management fee and the MER just to get the full picture of what that ETF is charging you. And I will also add, which I didn't mention earlier, is if you're looking at an ETF from a due diligence standpoint, see if there's other strategies out there. What are the other strategies charging? If there's an asset allocation ETF that's doing the same thing as a BMO asset allocation ETF, but it's 20 basis points and a BMO 15 basis points, you have a good idea of where you can be putting your money if you're getting the same thing, but it's different price.
For sure. Yeah, me personally, I always use the MER, like the management fee, as my benchmark of what is considered a low fee versus a high fee. So for the asset allocation ETFs, I would consider that like on the lower end. So anything above that, there better be a really good reason why it's more, in my opinion, because it's like, why would I pay that if I could just get an asset allocation ETF for this really low cost? So at least in case anyone's curious, that's pretty much the benchmark I use. Is anytime someone's talking to me about fees, my first point of analysis is how does this compare to an asset allocation ETF? But that's really interesting, the point you said about how it has to be a full year before it gets reflected in the MER. Can you refresh my memory? So, because when we have the actual management fee, that's something that you guys control, that the ETF provider actually has control over. But then there's the difference between the management fee and then what the MER ends up being. So there's that bit of a spread. And last I checked, I remember it has to do with taxes, I think, right? Can you speak to that a little bit?
Sure. And yes, the difference between a management fee and the MER, most of it is tax, and that will change depending on your province that you're in. So that's to think about. But the MER for each fund is audited at the end of the calendar year. So we can't market a lower MER, even though the management fee is lower and that MER will subsequently be lower. We cannot market it. Again, this is a regulation thing until we've had the management fee for a full calendar year.
Gotcha.
So the management fee was cut at the beginning of the summer in 2025. So we need a full calendar year, full 2026 year. Then the MER will drop. We can market a lower MER.
Gotcha. Yeah, that's interesting because I remember when I was analyzing, after you guys did the drop, I looked it up and then I compared it to someone else. It was either iShares or Vanguard. I think it was iShares. And then the MER was actually the same, even though your management fee was lower. And so I was wondering, well, why is that? It shouldn't have dropped. But that what you just explained makes sense. You actually have to wait a full year, then you get the most accurate, up-to-date numbers. So that's good to know, I think, for any investor that sees that and thinks, well, hold on, why is it still the same MER? You're saying that's basically a very temporary thing because you have to wait for that 1 year to lapse. Is that right?
Correct.
Okay, awesome.
Yes.
There you go. Awesome. I learned something. Great. Thank you. I was wondering why that is. I'm like, what the heck? Why you guys dropped it and why is the MER the same? So that makes a lot of sense. And so the tax piece, I'm guessing is that pretty, like that gap, right, between the management fee and the total MER, is that something that is pretty much the same among the different providers because they're all following just total market index, they're not trading a lot, that kind of a thing. So is that usually a relatively similar amount among the providers? Do you know?
Well, yeah. So your management fee will go up by usually the tax. That's pretty much the only difference there when you're looking at the MER versus the management fee.
Okay.
But then there are trading expense ratios that are associated with some funds. That is something you can look up in the fund facts of those funds, what those TERs are. Generally, they're very low. There's certain strategies that could be higher. If you have a very active manager that's trading really frequently, they can be higher. Something to call out, but usually they don't impact, from where I'm sitting, they don't impact most funds, but they can be an impact.
Right. Yeah, because, okay, that makes sense. But yes, that's a good kind of thing, I guess, for us DIY investors to remember was that if you hear about a rate cut from a provider like what you guys did at BMO, to just remember that, okay, it's going to take a year for that MER number to update. So that's really valuable, I think. With this whole episode, I'm trying to catch these sort of analysis mistakes that as DIY investors can make sometimes, because I even went to school for this and some of the stuff we didn't even learn, especially because things have changed over the years, right? So I think that's really valuable for us to know. Great. And now a quick message from one of our sponsors. There are so many opinions on how to invest your money today, but it can be hard to find credible voices to rely on in the world of finance and investing. One resource I turn to every week is the ETF Market Insights YouTube channel, led by today's episode sponsor, BMO ETFs. Market Insights brings in industry experts, and their weekly episodes cover the hottest themes like inflation, infrastructure, healthcare, and more. Tuning in helps me stay up to date on what's happening so I can be a smarter investor. And you can also submit your own ETF questions to be answered on the show. So do yourself a favor and subscribe on YouTube to ETF Market Insights or visit etfmarketinsights.com so you can be notified when future episodes go live. Are there any other charges or fees that we should be mindful of in addition to just looking at the MER for an ETF or mutual fund?
Well, I talked about the TER. There can be leverage costs. At BMO, we don't use leverage in any of our ETFs. There are a lot of ETFs on the market now that are using leverage, and a lot of direct investors are researching those funds. They're becoming a little more popular. So just understand that is separate from your MER. And the leverage cost can change year over year because what really impacts that leverage fee is your financing rate or your rate of borrowing, which, as we know, that usually isn't stable. It changes based on the rate environment. So that is something for investors to be aware of if they're looking at leverage ETFs.
Gotcha. Okay, that sounds good. And when we are evaluating what to invest in, what is the easiest way to determine whether a fund is active or whether it's passive?
Easiest way, look at the prospectus. A lot of ETF providers actually will just publish this on their website. If you can't find it on the website, look at the prospectus. It will be laid out for you what's the investment strategy of that ETF. The prospectus is there for a reason. It's there to protect you as an investor. That strategy, you're bound to that strategy as an ETF provider. So if I say I'm an S&P 500 ETF, I cannot go out and buy equities that are not in the S&P 500. I can't do that. So look at that prospectus and you will see, is it tracking an index or is it active? And if it's active, what is it telling you that it's going to be doing? Because that fund manager is bound to that prospectus. They can't deviate from it.
Gotcha. So I guess that's another kind of going back to our earlier question about, okay, well, us determining what's marketing versus what's actually highly regulated by the regulators. So in this particular case, if you're Google an ETF and you go to a fund provider's website and you're reading it there and it says, okay, we try to track the total US market, for example, or we try to track the S&P TSX with this ETF. We don't have to have our guard up as much, I guess, when we see that on the provider's site, because that's not something that they can just make up and then go off and do their own thing. That's actually something that we can trust, it sounds like, because it is a regulated component, yes?
Yes, regulated. Absolutely.
Gotcha. Okay, that sounds good. Yeah, because as you know, right, there's so much, especially like with the social media and influencers and all that, there's so much information. Some of it's right, some of it's wrong. And so I find in this day and age, it's like we have an abundance of information. And now it's how do we determine what is actually good data to use, what is good analysis that we should be doing versus just believing everything we see, right? So that's good to know. Some managers of high fee actively managed funds will often try to justify their higher fees by saying that those fees are offset by the market-beating returns that they generate. When we hear an argument like this, how can we pull up their fund and compare it to an index fund to see the return after fees in order to determine whether their claim is actually true?
Okay, so I will just highlight that all published return numbers should be after fees. That's another regulated thing. The fee comes right out of performance. That's how investors pay for funds. So published return is always after fees. If you are comparing an active manager versus an index, first I want to highlight, make sure you're comparing it to the right index. If I'm looking at a Canadian equity active fund, I shouldn't be comparing that performance to the S&P 500.
Right.
Know who to benchmark the active manager to. That's the first thing. Second thing, performance. All you have to do is look at performance, and there is a team out there at S&P Dow Jones Indices. They create these speed report, and it makes it really easy for investors to see long-term trends of active managers versus passive. And so you can Google it, SPIVA. You can read the speed reports for yourself. But what you'll see over the long term is that it's very, very hard for an active manager to outperform their underlying benchmark or the index over the long term. And the data doesn't lie. You can check it out. But if you'd like to use the BMO ETS tool, that's a great tool too. Our compare tool, you can put in the active fund versus something like an S&P 500 ETF. You can get an indication there. Is that active manager really providing alpha? Or are they only doing it in the short term, not the long term? It's just something to look at.
And just to confirm, even if someone, let's say, Googles a particular ETF or a particular fund on Google Finance or something like that, all of the, or Yahoo Finance, pick your tool, those are all always after fees as well, right?
Yeah.
Okay.
Correct. So if, for example, if I'm looking at my Bloomberg terminal, which I know direct investors don't have access to Bloomberg, but if I put in the S&P 500 index return and ZSP return, you'll see a slight variation, and that's the fee.
Gotcha.
That's the fee difference.
Okay, excellent. That's good. Great to know. Yeah, I think it's really valuable to know, especially when someone's getting pitched certain higher fee products, right? And again, also look at the, like you said before, the volatility as well, and not just be so fixated on return.
Right. Yeah. Look at the risk. What's that active manager doing? Because quite often active managers have more concentrated positions. They keep smaller portfolios. So understand the risk associated as well with that promise for outsized returns.
That's true. Yeah, that's a good point. Now, one recurring challenge that I've seen some Canadian investors face is that they are at the point where they are convinced that an all-in-one passive index ETF is right for them. They're ready to just do that. But they currently hold some investments that have done better than the index over the short term. For example, maybe they purchased a high-fee actively managed fund years ago, or perhaps a specific stock that has outpaced the market over the last year or two. Now, in those scenarios, how should the investor be thinking about those investments? And what are some common blind spots or errors in judgment that you've seen when investing in this way?
Right. So we call this a core and explore way of investing. And a lot of direct investors like doing this. So they take the core allocation of their portfolio and they put it in something like a broad market ETF or an asset allocation ETF. And they know that, hey, okay, 80% of my dollars in this investment account are in a globally diversified low fee fund. I feel good about that. But hey, I have the other 20%. I might want to explore an equity opportunity that could tilt my portfolio towards a little more growth. Or perhaps I have conviction in a specific sector and I want to look at a sector ETF to tilt my portfolio that way. Or perhaps I need some extra income and I want to look at a few enhanced income ETFs around that core. So this is how we look at combining two different types of portfolio positions to make it work for you. But I always bring it back, like, how is that, if there's a certain stock you want to add, how is that going to help you get to your goals? And what's the risk in that stock? Is it a small cap startup firm, or are you looking to buy Apple stock? Those have two different risk profiles. Understand if that matches your risk profile, and if those additions to that core holding, are they going to help you overall get to your goals?
Mm-hmm. Yeah, one mistake I've noticed, or I guess error that I've noticed speaking to one particular investor recently, was they would say, okay, these are some stocks I bought years ago. Now I'm just an index investor. I've transitioned to just being a DIY index investor. They buy the ZEQTs or whatever fits good for them. But I still have these stocks, and they'll say, oh, well, but this one's gone down a bit. I'm going to just hold on to it and wait until it recovers, which is, to me, scary, right? Because there is no guarantee that it's going to return to its previous high one day. If you look at historically, the stock market as a whole has gone up over time, over long periods of time. But then if you're looking at these individual companies that someone's bought, or even in like an actively managed fund, there's no guarantee that it's going to keep going back up, right? And so I can see it being troublesome for an investor to just play this waiting game for something that may never happen. And then every day that they are invested in that is a day they could have been invested in their now current strategy. And especially if they're in like a high fee fund where they're getting charged really high fees regardless, even if their performance is not good. So I don't know. That's just one thing that I thought I'd mention, because I talked to DIY investors and I help family with this as well. And I've had a few people that wanted some coaching help. And I've noticed that sometimes it's easy to fall into these types of things where we're waiting, hoping for things to recover, but it doesn't always recover.
Right. Well, it's such an emotional bias,
Yeah.
right? Hey, well, if I'm in the red, as long as I'm not in the red anymore, okay, I'll feel better. But if it took you 5 years to get out of the red, where you could actually just feel at a loss, and if you went into a broad market ETF that was going to go up quicker than you waiting to recover, things to think about. It's a lot for an investor to think about, but right, to separate those emotional biases can be helpful.
For sure. There are many asset allocation or all-in-one ETFs available to investors right now. Can you walk us through the due diligence process when comparing these types of ETFs?
Sure. So again, like just going back to those basics we talked about at the beginning of our conversation, Cornell, like the firm reputation. Has that asset manager been doing this for a long time? Have they been in the ETF game for a long time? Do they have track record? what's the fee on that asset allocation ETF? And I will tell you, there's different flavors going out there for investors. There are the broad market kind of plain vanilla that we focus on at BMO with those underlying broad market index ETFs in that asset allocation ETF. But a lot of asset firms are trying to mix it up and differentiate themselves. They're putting good strategies on the market. They're putting speculative asset classes such as Bitcoin into these types of funds. So really look under the hood of that asset allocation ETF. They aren't all built the same. Understand what it's invested in and does it align with your goals. Also know that equity fixed income breakdown. That's the beauty of these funds. You can find something that matches the exact equity to fixed income breakdown that's best for you. If you're an investor with a very long time horizon, a little higher risk profile, and your objectives of growth, you might not need a fixed income. You might just look at something like a ZEQT that's all equity. But if you're nearing retirement or want a little more stability, or if your risk profile just says, hey, I can't stomach a 30% market drop in any given year, you may want to start adding a little more fixed income allocation to that account and to look at that equity fixed income split, because we say the number one driver of returns is your asset allocation equity fixed income split. That's the first decision, the most important decision you can make. So make that decision correctly. And then just understand again, like what's the underlying holding in those asset allocations, because they do differ across firms.
Yeah, and for that one, for anybody new to it, you can just go to the ETF provider site and there's always like a holdings tab and you can click on that. And then there you'll actually see what is within that ETF. And that's, so when Danielle says looking under the hood, correct me if I'm wrong, Danielle, but that's what you're referring to, right? Is actually going to that holdings tab, see what's in there, right?
Right.
Yeah.
Correct. You might have to look under the hood twice with asset allocation.
True.
ETF, right? Because they're holding more ETFs. And then so you might want to research what those other ETFs are holding.
That's true. Yeah, because if you mentioned ZEQT, if you look at that and then you look at holdings, well, within that, it's like there's ETFs within the ETF. So now you might want to look into the actual ones underneath to see what is this? Oh, this is for Canada. Oh, this is for US, that kind of a thing. But yeah, I'm really glad you brought up the asset mix of the stocks to bonds, because I could see maybe someone that's new to all this or just new to transitioning to being a DIY investor. Maybe they look at something like a ZEQT, like an all equity asset allocation ETF, and then they compare it to another provider's more conservative one that has like a 60-40 split. They might think, okay, well, this one's clearly better than the other because it's got a higher return over the long term. But then they might forget to actually look at the volatility. It's, well, yeah, because this one's 100% equity, the other one might be 60%. And so you're going to see differences in volatility and to be basically ready for that. Because I could see someone just making that kind of quick back on the envelope. They just quickly look up the total returns and pick the highest one. So I'm really glad you drove it home that we do need to look at more than just the returns. But it's so easy to fall into that trap, right? And a lot of the sales pitches I've noticed that I've heard over the years for investments, they talk so much about the returns and then they don't talk so much about the fees and the volatility, because that's, I guess, the main selling tool is look how much higher you'll get with us kind of thing. So I'm really glad you're helping educate Canadians that we do really want to look at it holistically instead of just being so fixated on that return number, which is not the whole story. So Danielle, thank you so much for coming on. Are there any other educational tools and resources that you can direct us to? You mentioned the ETF comparison tool, which I love. I've been linking out to that and sharing that quite a bit, especially because, like you said before, it's not just for BMO ETFs, it's for other ETFs, so you can compare the fees and see how much you're paying. So thank you so much for that. Tell us more where we can learn more. What other resources do you guys have?
Well, BMO.com/ETFs, we have a great education center there. But yeah, go to that fund comparison tool. It's wonderful. It's free. You can compare all the ETFs. You can spend tons of time on it. I don't even need my Bloomberg terminal anymore. I use it so much. So please check that out when you're doing due diligence for your investment accounts.
Awesome. All right, Danielle, thank you so much. And I'll be sure to link out to everything in the show notes as well. And yeah, thanks again for coming on and educating us and making sure that we do a lot less mistakes when doing our own analysis as DIY investors here in Canada.
Oh, it's great to be here. Thanks for having me, Cornell.
All right, thanks, Danielle. Bye. All right, I hope you enjoyed the episode. Please share it with someone that you think may find it useful. And of course, leaving a review on Apple Podcasts or Spotify is always super appreciated as well.
Thanks for listening to the Build Wealth Canada podcast at www.buildwealthcanada.ca.